Welcome to Money Through Ease, the podcast that helps small business owners overcome limiting beliefs and take control of their financial agency. I'm your host, Regan, founder of All Ease Accounting. Join us as we explore ways to empower yourself and achieve financial success with ease. Hey y'all, welcome to Money Through Ease. I'm your host, Regan, and today's episode we are talking about whether or not you, as a business owner, need to break even to pay yourself. This is a question that I've never gotten directly from a client. Like, no one's ever directly asked me this, but I see a lot of people talking about it or thinking about it or having discourse about it, that when you're a small business owner, what I hear is that you get paid last. Like, the business brings in money, it brings in revenue, but you have employees to pay, or you have supplies and materials to buy, or you have software that's coming due. And so you have all this business overhead and you have not factored in what you need to pay yourself from the business. And if the business is not breaking even, that you're the last person to get paid, and sometimes you don't even get paid at all. This is what I hear a lot of business owners saying. So I wanted to do an episode on this concept and teach you what is actually going on in your finances when you're experiencing this. When you're thinking to yourself, I'm the last person that gets paid. Everybody else gets paid before me. All the bills get paid before I get my check or my cut. And it's okay that you're thinking that way, but it's a little incorrect to think this way. And I don't think that people understand like where their money is going in their business. And so we're going to talk about which reports you can look at and pull and review and analyze in order to figure out where exactly your money's going, and how it's not the case that you need to break even in order to pay yourself. So let's start by defining breaking even. To break even is the concept of making at least as much in revenue as you paid in expenses for your business. I'll repeat that. If you break even, that means your business is bringing in revenue more than it is paying out in overhead and expenses. This would mean that you have a positive bottom line, right? This means that you have a net profit at the end of the day. You've brought in more money in income and revenue to your business than what the business needs to spend money on, aka its expenses, in order to stay open and operate. So breaking even is the case where your total revenue has to be equal to or greater than how much you pay in expenses. Now let's talk about the different types of owner's pay. So if you've probably been listening to the podcast, but if this is your first time, I'm going to re-explain this concept. If you are a single member LLC or a sole proprietor, this is how you pay yourself. You take draws from your business. That's what it's called, owner's equity draw. This is you actually transferring money out of your business account into your personal account. Or you can write yourself a check from the business and deposit it into your personal account. I don't care. All of that is considered a draw. Draws are how we pay ourselves if we are not incorporated. If you are a sole proprietor, if you have an LLC, but you did not make the election to be taxed as an S corporation, so you're an LLC, but you're not incorporated, then you take owner's draws to pay yourself. Draws are not taxable at any point. Owner's draws is an equity account in your bookkeeping. So just like we all put equity into our business, by putting in the sweat equity, we invest personal funds into the business in order to help it get started. You put equity into the business, which means that you get to withdraw equity from the business by just simply taking cash out of the business. Draws do not show up on your profit and loss report. If you pull your profit and loss report, if you run your profit and loss report and you see owner's draws on there, that's a mistake. Those transactions need to be reclassified, and your owner's draw account should be an equity account type. which means that it shows up on the balance sheet. It does not show up on the profit and loss statement. So reclassify any owner's draws on your profit and loss statement. Reclassify those to your owner's draws equity account. Draws are not an expense to the business. That's why it's not showing up on the profit and loss, right? The profit and loss shows us what business expenses we have, among other things. But draws are not an expense to your business. It's not something that you get to claim as a business deduction. It is equity. Draws are not income to you. So just because you're paying yourself, quote unquote, paying yourself from the business, you don't have to claim what you drew from the business. The funds that you withdrew from your business to pay yourself, you do not have to claim those on your personal tax return. What you claim as your income for sole proprietors and single member LLCs, you claim the net profit or loss. So net profit would be a positive number, and net loss would be a negative number, reducing your income. You claim the profit or loss of your business on your personal return as your individual income. That is how draws work for people who are sole proprietors and single member LLCs. If you are electing to be taxed as an S corporation, that means that you've actually filled out the form to make that election. Then you will take an owner's salary. That's if you have made the election to be taxed as an S corp. You will pay yourself a shareholder employee's salary because you are a shareholder in the business, but you're also working in the business and providing services to the business. You're doing work operating the business. If you pay yourself an owner's salary because it's an S corp, taxes are withheld from that salary. You claim your salary from the S corp on your individual return. Just like any other W-2 job, if you are the owner or shareholder employee working in an S corp, you get a W-2 from that business. So those are the ways that you pay yourself as a business owner for those instances: sole proprietors, single member LLCs, and S corporations. I'm not going to go into the other business entity types because it's really not that important for right now. You will probably fall into one of these categories if you're listening to this podcast. And we'll be right back. Ready for an accounting date with an expert bookkeeper? Sign up for a fourth quarter fling. I'll send you a customized workbook, expert insights about your business, and you get a one-on-one virtual call with me. Plus, an early bird bonus awaits if you sign up by October 1st. It's cuffing season, so let me take your business on an accounting date. Find all the details in the show notes and secure your spot now. Welcome back. We are answering the question today: do you have to break even in your business in order to pay yourself? So the short answer is that technically, no, you do not have to break even in order to pay yourself from your business. So when you're deciding on what you're going to take out of your business as far as your owner's draws, if you're a single member LLC or a sole proprietor, or if you are deciding on your owner's salary that you're going to be paid as an S corporation shareholder, you can make the choice of how much to pay yourself based on the cash flow of the business. You can base it on whatever you want, to be honest, but I recommend that you at the very least look at your cash flow and decide what the business can afford. If the business cannot afford to pay you out of its cash flow what you want to be paid, what you want to make, you might need to change some things around. But we always look first at the cash flow to see if it can support paying you from the business. So your cash flow is calculated by other figures besides your net income. So whether or not your business is in the black or if you've broken even. In the black would mean that we have a positive net profit. We have more revenue coming in than we have expenses going out of our business. We have a positive number for our net profit. This would also be breaking even, right? As we discussed before. So the business can have different ways that it increases its cash flow other than adjusting how much money it is making in revenue or how much money it's spending in expenses. So here's a few ways to increase cash flow in your business. And these aren't all of the ways, but I just did a little brainstorm to come up with a couple of ways to share with you how you might be able to increase your cash flow in your business and therefore pay yourself more. Number one way to increase cash flow, and these are not in any particular order, this is just how they came to mind. Number one is to sell an asset. So if you have a vehicle or a piece of equipment in your business, or you've got the secret family recipe for the sauce, the tomato sauce or whatever, and it has value, an asset in your business that has value, you can sell it, right? You can just liquidate it is really what that means, to bring in cash to your business. And if you have like a vehicle that you sell to bring in cash, if you have financing for that vehicle, if you still have a loan for that vehicle, whatever cash you make from the proceeds of the sale of the vehicle, you got to pay off the loan first, right? I mean, you could still keep the loan and just keep the cash, but why would you do that, right? You pay off a vehicle loan whenever you sell a vehicle. And then if there's any cash left over from the sale after you pay off the loan, that's cash. That's increasing your cash flow. So that's one example. The second example of increasing your cash flow would be to take out a loan or draw from a line of credit for your business. So when you finance something, anything in your business and your personal life, that means that you get money in your hands if you qualify for that financing. The lender has decided, yes, we will give you money to do whatever you want to do with it. You can get a line of credit using different assets in your business as collateral, right? You can, if you already own a vehicle, maybe you've paid the vehicle loan off, so you own the vehicle outright. You can put up that vehicle, you can put up a building or land, or even your accounts receivable as collateral for lenders to give you money. The way that accounts receivable works is that you have invoices that have gone out to your clients and customers, and you're waiting for them to pay you money. They owe you money for those invoices. So that is called an accounts receivable. That means that if you needed to, you could go collect on that money according to the terms of your agreement with those customers. If someone owes you money, that's an asset to your business technically. And you can put up whatever you have in accounts receivable, whatever that balance is, as collateral. And lenders who do accounts receivable loans will give you money based on the value of what you need to collect on from your customers. So if you put up collateral like a vehicle or a building or land or your accounts receivable, if you put up that collateral to get cash, that means that if for some reason you weren't able to pay that back, the lender will come seize that collateral, right? They will repo your car. They can put a lien against the land. And as long as you're paying a loan back on time, you can get cash in return for lenders having that claim to your business assets. Like for a building or for land, if you put that up as collateral and then you defaulted on that loan and you weren't able to pay it back, the lender would put a lien on the land or the building, and then if the land were ever to be sold, the lender gets to come collect the proceeds from the sale, right? Like you wouldn't get this the money back for the sale of that asset. So that is the second way to increase cash flow, is to take out a loan, get a line of credit, which is a very common thing to do in business, to leverage debt that way. You can also, number 3, pay off a loan or other financing. So if you've got a loan like a business line of credit, or maybe you have some credit card balances, and every month you're paying those loans back, you're paying down those balances. Well, once those loans are paid off, once those credit card balances are paid down, now you get to keep that cash that you were paying every month in your pocket. So that could be a way to increase cash flows, to pay off a loan or some other financing, so that you're not having to make that payment every month. Now you've got a little extra cash every month in your pocket. That increases your cash flow. And finally, like we talked about, in order to increase your cash flow, number 4, you can increase your revenue. You can go out and sell more, you can acquire more clients, whatever you got to do to make a little extra revenue, right? And you can also cut your expenses. So if you take a look at your expenses and you decide to part ways with some of your vendors, or maybe find a vendor that can get you supplies at a cheaper cost, you can cut expenses. And so all of that will increase your cash flow. So increasing your revenue, decreasing your expenses, that choice is obvious. It's probably the first thing that people think of when they think about increasing their cash flow, but I'm including it on this list anyways. But most people don't think about like selling an asset, taking out a loan, or paying off a loan or a credit card as a way to increase their cash flow. But that is how the financials work. That's the system that we're working with, right? So in order to pay yourself as the business owner, if you need to increase your cash flow in order to support paying yourself, taking draws, taking a salary, you can make those adjustments to your cash flow, and it doesn't have to involve breaking even, right? Cash flow is not solely dependent on whatever your business revenue and expenses are, as we've shown. So my final answer to this question is, well, the question is, do you have to break even to pay yourself? And my final answer to this question is no. You do not have to break even, because you don't necessarily have to have more in revenue than you pay in expenses in order to pay yourself as the business owner. There are so many ways to increase your cash flow to support taking the draws that you want to take or having the salary that you want if you're a shareholder of an S-Corp. So if you want to know what your cash flow is and why you hardly have any money left over to pay yourself after everybody else gets paid, get on a 4th quarter fling with me. This is a perfect opportunity for us to look at your financial reports together, see where cash is flowing out of your business and not into your bank account like you want it to. The link is in the show notes to sign up for a 4th quarter fling. Remember that you have until October 1st to sign up and receive a special bonus. The 4th quarter fling can be booked anytime now through December 31st, 2023. So there is limited availability on that, so get your spot locked in before they're gone. Thanks for tuning in to Money Through Ease. If you enjoyed this episode, make sure to subscribe to my email list to stay up to date on all the latest content. You can also follow me on social media at All Ease Accounting or facebook.com/accounting with ease for even more insights and updates. And if you're interested in learning more about my bookkeeping services, don't hesitate to schedule a complimentary consult today. Thanks again for listening, and I'll see you next time.